Hello viewers, today we are going to do a first simulation on the special acceptance of a special price. And we are going to first of all look at a class example and we see what we can have so that we can be able to have the basics before we go to the past paper numbers, because we are going to do like 3 simulations. If we finalize the class example, we are going to look at August 2015 question 2. When that one is done, then we shall finalize with September 2022 question 1 part A Roman 2. And that will bring to the end of the computations. The computations that we may have as far as the special acceptance of a special price. But there are other trial numbers like June 2013 question 5. You can look at it and also have wider coverage. But let's try to first get the class example. We get the basics that we need to apply. But as a precursor of what we discussed under acceptance of a special price, we said that for a special price, we look at the contribution analysis. We make sure that if the special price is going to result in a negative contribution, we decline the offer. If it is resulting into a profitability, a positive contribution, then we can also try to accept that special price. But how do we make a decision? How do you make a conclusion? We make a conclusion by first of all looking at the financial performance of the company. This is a company financial performance before the offer is accepted and after the offer has been accepted. In other words, we try to look at what is going to be the better position of the company if at all we accept and before we don't, before we accept and after when we have made a decision to accept the special offer. If this is going to result into a profit, we take up the special offer. If at all is going to result in a loss, we leave. Because you may find that when you do the computation or the financial performance, because financial position, we are not meaning the balance sheet here. We are meaning the income statement. We look at the profitability. We are computing the profitability. If we get the profit, and the profit may be, because we may have scenarios that the profit you computed before taking up the special offer is higher than after taking up the special offer, then we can decide to decline it. So the decision points, they are always in a sense of looking at the contribution and at the same time looking at the profitability of the company. So someone may be wondering, why should we even accept the special offer? The special offer is always accepted because we need to get rid of stock. If you have more stock and we need to complete the stock before it is maybe it is expiring and all that. So if maybe stock, because you see, when you start keeping stock, you are even increasing the cost. You have to incur storage costs, safety, so security and other costs are going to come in just because we are keeping the security. That's why most of the times you find that even if you are selling at a lower price below the standard selling price, you may find that we are selling up. So long as we are not going below, or we are not, it is not affecting our, so long as it is adding on the financial position of the organization, we go with it. Because adding on the financial position, we know when you are preparing the balance sheet, we always add the net profit after the capital within the equity section, we add there the net profit. So if the net profit is going to add something, then we can be able to take up. So that's what we can basically talk about. But let's look at the question and we see what we can do. The question says ABC Limited has the following cost profile. So we have the cost per unit. In other words, the cost per unit here we have is a cost per ton. A ton is our unit of measurement. We said 1 ton, or we know that 1 ton is equal to 1,000 kgs or kilograms. So we have a cost per ton. We have amounts in shillings. We have direct material per unit. Now in this time it is per ton. The unit of measurement is per ton. So we have the direct labor, we have the variable overhead per unit, we have the fixed overhead per unit, we have the total production cost per ton or per unit, we have a markup of 10%, we have the factory selling price of 7,770. So the company produces 100,000 tons of soap to satisfy its market or to satisfy the market. They are saying that before, orders have been received for only 90,000 tons. However, a customer has made a special order of 10,000 tons at a price of 680 per unit. Then the required says, should the company accept the special order or not? That's going to be our first simulation. The second simulation we said is going to be from August 2015, question 2. So what you have first of all to note from a special order or a special price or a special offer is that if they have given you the company, what the company produces, like here they have said what the company produces, they are 100,000 tons of soap. But in the normal market, they sell 90,000 tons, meaning there is extra of 10. What you have to know from all these questions that involve the special order or special offer, we shall have the balance is always, we can't exceed the normal capacity of the business. If the business is producing 100,000 tons of soap, we can't say that the special order came in for 20,000 tons. Yet when you add up, you will get 110. No, it is always when you add the normal order and the special order, they should give you the total. They will be equal to the total production capacity of the company. So that's what I wanted you to know from that. There is no way they will give you something that is exceeding the production capacity. Maybe if there is an additional information that has been talked about, maybe on the addition of more extra production of an extra units. But we can't exceed what we can produce. So let's go to the Excel sheet and we see what we can have. Because we say one of the things that we look at the financial position before the order is accepted and after the order has been accepted. We make a decision based on what is better. Is before better than after? Then we decide on that. So let's go to our Excel sheet. So here we are going to look at the profitability. We said we look at profitability before. Profitability before the order or the special order, before the special order is accepted. Now we need to compute the normal income statement that we had using the information they have given us. We are going to have the details. We shall have maybe workings here, or we can leave the workings and we put maybe now maybe the amount in shillings. We said everything is in shillings. So we can start with our revenue. Here we are not going to copy to make working because it is something that is very small. Our revenue, maybe we just push this to there, maybe you can just put in the figures there. So we have the revenue, and the revenue they are saying the revenue is, they have given us the selling price per ton. Now this is going to be for the normal market order. They are the units we are computing before we accept. Before we accept, there were 90,000 tons. 90,000 tons. So it will be that we multiply by the selling price. The normal selling price was multiplied by the normal selling price, which is 770 shillings. So this will give us a cost. This will give us 60. This will give us 69 million, 69.3 million. So we go to our, now we go to the variable costs, because we need also to show the contribution. They have, whenever you see that they have specified costs, whenever you see that they have given you the fixed costs alone and they have given you the cost, the variable costs alone, just know they want you to compute the contribution. So we have the fixed costs. Let's first take off the variable costs. The variable costs will have direct material. You can just call it material, but you say it is direct material. Direct material, they gave us the cost per unit, which is 90,000. 90,000 tons, we multiply that by the cost per unit, which is 300. So this will give us 27 million. So we go to direct labor. You can call it labor. Labor, we take the same units, which are 90,000, multiply that by the cost per unit, which is 300 also. And this will give us also 27 million. So we go to the variable overheads and just call them overheads, but they are variable in nature, overheads. These, they gave us also a cost per unit, which is 90,000. The number of tons we multiply by the variable cost per unit, which is 50. So we first get that, and this will give us 4.5 million. So here now we get the contribution, because the contribution we have exhausted all. Now the contribution, or the total contribution, we sum up these. We sum up all of this, and when we do, we sum this and this and this and this, we sum all of them at once. That will give us 10.8 million. So it is this, we are getting the totals here. Let's just first get the total variable costs. Total variable costs. So that we can know that at least these, now these are going to be in brackets. Can just place out equals. It will first of all, we first add those ones. So we get now the contribution here. Back to the contribution. The contribution we are getting the sales units. This will less off this. So that will give us 10 million. 10.8 million. So this we can put it in maybe in a bracket to show that we are lessing it off. But if you do that, then we have to change also the formula here. And this one we just add. So that will give you that. Then we less off the fixed overheads. Less off the fixed overheads. They also give us the fixed overheads. The fixed overheads, they gave us the cost per unit, which is, we are taking the 90,000, which are the number of units, we multiply by 50. So this will give us a 4.5. But remember, this 4.5 is going to be in bracket because we are lessing it off. It is 4.5. So we can now get the profit or loss. Profit, loss. This will be, it will be this. Add this. The reason we are adding because the other one is already in bracket. So this is the profit. This is the profit that we are going to get before we accept the special. So we can even highlight this. Before we accept the special offer. In other words, this is going to be profitability as per the 90,000 tons. And just put this in bracket. The 90,000 tons. Tons. We can now look at when the special offer has been accepted. Look at when the special offer or after the special offer, the special offer or the special order was an order is accepted. So we said we prepare two things. We prepare before and after. We are also computing the same, it is profitability. Can maybe add it here, it is profitability. Profitability. Now, these units are going to be, we are getting the 90,000 tons. 90,000 tons, we add. These ones we are going to add the 10,000. In other words, we are taking for the whole number of units. So that's it. We get for all the units. In other words, it's like we are looking for the whole 100,000 tons. So here we are going to split this into the detail. Okay, we can start with the details here. Details. Then here we can just copy the whole of this information because we are going to split this into the 9,000 tons. We split this into the 9,000 tons. Then we show also the 10,000 tons because the costs are going to be different. The other one, they have given us the cost per unit, which will give us a different cost. So this one, we put also the 10,000 for the special price, 10,000 tons. And finally, we show the total. The total is going to be 100,000 tons. The whole production that the company did because they sold everything. if at all the offer has been accepted. It shows that everything has been sold. So we can just copy this, can just copy all this and we paste it there. Can copy this and we paste it, all of it here. So that's it. In terms of the costs, we've computed everything here for these 9,000 tons. Can maybe highlight this. Just know here we are taking the totals. Then put totals. So since we are getting the totals there, and just make it a bit wider. So that's it. Here we can make the profitability, we can make also that one. So we can also highlight the contribution. I have a reason as to why we are doing so. So these are the ones that we are going to be computing. We are computing now for the number of units which are going to be these on the day 100,000. So we are also going to compute the profit that we are going to get from those ones. How are we going to be able to do that? It's going to be done like this. Even this one, I can make it a bit wider. Because here we are going to compute. What are we going to be computing? We are computing for all these costs that we incurred for only the 10,000 units. So in other words, it's like we are just getting, because everything was cost per unit. If they were cost per unit, it means we are going to make sure that these costs are going to be making sure that these costs are going to be per unit for every item. So this one is also going to be, we shall get the 10,000 units, multiply that figure by, we shall get the 10,000 units, the 10,000 tons, multiply that figure by 770. That is the selling price. We first of all, first look at the costs. They said the profits that we are going to get from that. No, this one we are not going to multiply by 770 because they said it's going to be sold. Sorry, this one is going to be sold at 680. Sorry for that. It is 600. The selling price is 680. For each unit is 680. So when that is done, we shall get the profit. Sorry, the sales which are 6.8 million. That is that's the amount that we are going to be receiving. 6.8 million. So now what we have now to do is that maybe we can add in, for simplicity, we can just add in an extra column here. Can add in an extra column here. So we do these workings here. We can do these workings here. we do these workings here, but we put the figures here. So this is going to be 6.8 million, so that we can be able to add this very fast. So then we go to these variable costs. They are the same variable costs we are going to incur for all these products. Every cost that we have here is not going to change, because maybe if at all they had told us that the costs are going to change. But if the costs are not going to change, then we incur the same costs. So this will be the 10,000 units, multiply that figure by 300, which is the material cost that we are going to put in. So this will give us 3 million. So we can also put this 3 million here. Just want to simplify this. So this is also going to be the 10,000 units. We multiply that by the 300. So we can just scroll this because it is the same figure. So we get now the other overheads. Overhead, they say the cost per unit is 50. So it is going to be 10,000 multiplied by 50. 10,000, multiply that figure by 50. When we do that, we shall get a cost of 500,000. This will be 500,000. So we can put this figure also, 500,000. So we also do the same for now we can get the total costs here. When we get these total variable costs, we can just press Alt equals, we sum up those costs. But these are going to be in negative, or they are going to be in brackets. So we can put a negative there. So that when we deduct those costs that we are going to get, we can compute the contribution. So if you do that, you get equal sign this, because we are getting this, we are adding this one because it is in the bracket. When you add that, we shall get a contribution of 300,000. So it is this 300 that we are getting as the contribution from the 10,000, the 10 units. These are 10,000 units. You can also put the 10,000 tons. Can 10,000 tons. This is their revenue. This is revenue. Sorry, this is in shillings. So that's it. So we also compute the we have to compute the fixed costs. The fixed costs, they also told us it's going to be the 10,000, multiply that figure by the fixed cost per unit, which was 50. And that will give us 500. So it will be the 500 that we shall take here. So this is 500, but this one will be also a negative, but we can put it as a positive figure because we are going to less it from here. We put a negative because it's going to be less off. So So we need to get now the profit. Profit, we said we get the contribution, we less off the fixed costs. So this one is going to be, we get this, the 300,000. Since the other one is in bracket, we are going to add. And it will give us a negative profit. It's going to be negative 200. So what we have now to do is that we have to compute the total for each item. We are adding this. We add on this, and you can be able to get the total revenue. This is for the whole company. We are adding this plus, sorry. It will be this for the 90,000 tons. We add this. So that is the first approach that we can use. The other approach, you can just get the, but there is this is the only approach, because the selling price here is not the same. Only for these items which have the same figure, because this one you can just get 300 and you multiply by 100,000, you get the total for this. But since the other costs we are seeing they are not the same, you keep adding. This one we add this. So that will give us that. We can also keep adding until we go down here. So when you add, you will make sure you find that you are going to get a positive contribution down here. It is a positive contribution because you have 6.3. We less off the 200,000, we shall get 6.1. So that is going to be the profit that we are going to get at the end of the day. So this is what we've got. But before we accept the offer, we had 6.3. So it means our profit has reduced. So what they want us now to do, they want us to make an advice. How are you going to advise? Because they were saying, should the company accept the offer or not? In other words, what they needed us to do was to advise. So we go ahead and try to advise. What are we going to advise? We are saying that the company should not accept the offer. The company should not accept the special order. The special order, since accepting the offer, accepting the special order would lead to the company's profits. Or it would lead to company's profit reducing profits, reducing now they are going to be reducing from what? They are going to be reducing from 6.3 million shillings to 6.1 million shillings. Just like what we have seen, that is the advice that we could give the company. They should not accept it, because we are seeing that if they accept, their profitability is going to reduce, because they were better off here when they have not accepted the special order of the 10,000. They can still maintain they refuse and they remain profitable. Because the reason as why someone may be wondering why, because at the end of the day, they have received an additional revenue. Yes, they have received an additional revenue, But what you have to understand is that if these, because we had these fixed costs, why the problem came in when we had these fixed costs. These fixed costs that we incurred for these, they brought a cost of 500,000, and that 500,000 exceeded the contribution of 300, and that's where the problem came in. But we said with the acceptance of a special price, we always base on the contribution analysis to make a judgment. Yes, that one is true. But the reason as why here we are concluding on the profit and not on the contribution is because these fixed costs were per unit. They are not given us the total fixed cost that we incurred. These fixed costs, they were per unit. It means they were variable in nature because they were varying with the level of output. They were variable. Because if at all they had given us in the question, if at all they had given us the fixed costs in terms of if they had not given us the fixed cost per unit, and they have given us the total fixed cost, then that one would have been irrelevant for us. In other words, that cost would have been irrelevant for decision making. And we would now base on the contribution analysis to make our judgment. Because when you base on the contribution analysis, you are seeing that the contribution was 10.8 million. And here, after the acceptance, we had a contribution, a positive contribution of 300,000. Yes, they would advise the company to go with to accept the special order. But now, since these fixed costs were per unit, it means they were not irrelevant. They were relevant for decision making because these fixed costs per unit, they are more or less variable costs because they vary with the level of output. That's why we considered them. But if they had given us the fixed costs in a total, we couldn't consider that. We would just base on the contribution. So that's the reason as why we've seen that. Because we are going to do another simulation where we are going to be looking at maybe we base on the contribution analysis than the profit. So you have to be very careful when you are handling some of these questions, because some of these questions, they are going to give you fixed costs which are per unit. And if it is per unit, then it is going to be relevant for decision making. But if they give you the fixed cost in total, then they are not going to be relevant. It means we shall base on the contribution analysis to make decisions. Because what does this mean is that these fixed costs are going to be incurred so long as you produce the output. These fixed costs per unit, they are going to be incurred. But if you don't produce those extra 10,000, or if you don't sell those extra 10,000, you are not going to incur these fixed costs. Because that's why we are deciding that to remain at the point where we are not accepting the special offer is going to save us from incurring the fixed cost per unit of 500,000. These extra 50 shillings that we are going to incur on those 10,000 units, on each of the units, or on those extra 10,000, we are going to be saving it, because if we maintain our costs, we are only going to incur a fixed cost per unit of 450, which is a saving to the organization. So since there is a saving in cost, it means you can ignore the special offer. So we are going to look at the second simulation where we are going to be looking at where in the question they have given us the total fixed costs, and you can ignore them and you consider the contribution for decision making. So that's going to be in our part 2 of our next video, where we are going to be the question from the August 2015 question 2. That question 2 is where we are going to base on the contribution analysis so that we can advise the organization. So let's meet there. And for those who haven't subscribed, please do. Also make sure you hit the notification button so that you can be notified whenever we upload some new videos. And that's all that we can be able to provide for now. Let's meet in the next video. Thank you.